So thank you so much to those of you who have joined this fireside chat with me and Daouii, where we are going to have a little bit, I mean, those of you who know us, I actually don't think there are anybody who knows this, which is quite fun. Well, you would know that Daouii and I have a tendency to be quite frank. So if we say that this is going to be a frank discussion, I don't actually know what this next hour has in store for us. But the idea really was to talk about some of the challenges and some of the myths and some of the concepts that are being thrown around in the world of ESG and sustainability these days, and see how we just sometimes run our head against a wall and how we can jump over that wall, I guess, right? Daouii, I'm going to leave it to you to present yourself, because I think you are going to do yourself so much better honor than I would ever be able to. But just to let everybody know on this call, and for everybody who's going to see it later recorded, Daouii is an absolute power woman. So that's all I have to say.
You're awfully too kind, Kristina. I'll say the same about you. Good evening, everyone. Thank you for spending the last bit of your evenings listening to Kristina and I ramble on about ESG. As Kristina mentioned, my name is Daouii. I'm currently the head of ESG and sustainable finance at Channel Capital Advisors, which is an alternative asset manager based in London. In my role, I have the great fun of not only strategizing and thinking up our ESG plan, both at a firm level and more investment strategies, but also integrating that, rolling that out, working with our portfolio managers and head of business lines to think of bespoke solutions, and also at the same time working with our investors and our clients to help them not only meet their sustainability goals, but also improve their cost of capital over time relative to their sustainability profile. Outside of work, I'm a member of the World Economic Forum, a fellow at the Royal Society of Arts, and overall, I would say a global governance, geopolitical nerd, and aficionado. So that's where you can find me in my spare time.
So that's where we connected. It's the global governance nerdy part. Do you have a presentation you would like to share, or do you want us to just kick off chatting?
I was under the assumption that it was a fireside chat, so I thought
exactly.
I'd off and not have them pre-scripted.
But if there is something, then you just let me know, you can now share. So I actually wanted to start out by asking, so what are some of the things that frustrates you the most these days?
That's a very, very good question. I would say the first and foremost, what frustrates me is the misconception of what ESG is. There's a lot of buzz around sustainable finance and sustainable investing, and it's a radical transformation. I think 3 years ago in the markets, you would never have anyone even remotely talking about sustainability. And if they were, it would be in the context of the bond market. So it's great to see a radical shift, but at the same time, there's a lot of misconception and a misunderstanding of what ESG integration is. And it's everything from people thinking it's philanthropy to saving the world to it being this big kumbaya around the circle. And then on the other flip side, it's people thinking that, or portfolio managers in the belief that we're going to basically kill their business and shut shop. But I think ESG really is, and I'll just start off by labeling what it is from our perspective. It's a risk strategy, and it's similar to a credit strategy that somebody would underpin their portfolio with, or another type of investment strategy. It's about understanding some of the material risks, and yes, they are sustainability risks, but they are risks first and foremost. It's things that will impact the bottom line of corporates long-term, medium long-term, if they're not managed adequately, which has an effect on us as investors. So it's looking at non-financial metrics to get a holistic understanding of our underlying corporates and have a more robust asset selection criteria.
I think one of the things that I always come up against, and correct me if you think, or tell me if you think that this is me being silly, and then we will chat about that afterwards. It's always the thing that it's become an acronym that almost stands alone, as if it's no longer connected to the three pillars that those three letters actually represent. And it's as if it's fluffy up in the air, and either it is we save the world, or it's almost as if, oh my God, ESG is I'm going to offend ESG, and ESG is going to come and kill me. Like, no, this is a guideline on 3 issues, because we need to consider the environment, social governance, and then we also need to consider how they're interconnected. And that's another thing that often sort of baffles me, is how they're considered to be completely disconnected. I mean, for me, who's been working on good governance and social issues for, well, the better part of 2 decades, I'm always thinking, but how is it that governance is ignored? How do you think that you can do either E or S or anything without looking at your governance structure?
Exactly. I was on a panel this morning, and one of my co-panelists actually said it should be GES or GSE, because with good governance, the environmental and the social components would naturally take care of themselves. And I completely concur with you when you say people think it's this one convoluted acronym, and to a certain extent, data providers and data tools have been a source of this problem. Is people say, oh, we have an ESG score. And yes, you can, I think, to make it palatable on the tongue, it's easier to call it ESG rather than list out 30 million environmental factors and 30 million social governance factors. But they are very standalone factors. And even within different industries, they're very, very different on what you need to look at and what you need to analyze. So I think it's almost, I like to call them externalities now. I don't even use the word ESG internally as much anymore. I just call them deal externalities. Being an economist, it's probably the easiest term to use, but it's not necessarily a one shop or one glove fits all component. And that's one thing the markets really need to ensure that people get around their heads. Because when you say, oh, is a deal ESG compliant? Or I've heard, does this pass the ESG test? Is this an ESG deal? I'm like, nothing's really an ESG deal. Like, there's no such thing as an ESG deal. It's, does this deal pass the sniff test, and is it robust, and does it withstand time? And is it going to be something that will be here in 10, 20, 30 years?
Yeah, then let me come back to something you said also, that it's either let's save the world, or this is going to kill our business. Do you think that there is a possibility that we will change our thinking so that it becomes more about, I don't want to say saving the world, but right now I feel that there's a lot of hype that doesn't even remotely safeguards the world. Let's just put it like this. But do you think we're moving towards something where ESG is becoming more, not only this is me potentially doing something wrong, which will come back and bite me in the proverbial, but also more about, okay, how can I actually, without becoming an NGO, which is not the idea, but how can I become a more profitable investor or organization while I still actually really consider not doing harm and trying my best to have a positive impact?
I guess I'll start that one with profit and principle are not mutually exclusive. Historically, they have been because it's been profit at all costs and, you know, the bottom line. But I would argue that profit and principle are not mutually exclusive. Actually, they're complementary, and it's required to have one without the other. So to maximize profits, you need to be principle driven. You need to have not only a USP, but also have strategic insights on your operational inefficiencies, on how you can improve, how you can be more competitive. And all those things are sustainability factors. And when we look at where the world is shifting towards now, we're shifting towards a more stakeholder-centric form of capitalism. So if it's not getting access, so if you're a corporate, for example, and you need to become more sustainable, whether it's from your investors or from your underlying customers. And we've seen a lot of news articles and controversies surrounding companies who act in an unsustainable way, whether it's, and a lot of it right now is within food and apparel and luxury apparel, but that will, over time, I think in the next 5 to 10 years, be in every single industry. You're not going to get away with just bad performance or bad governance or having issues in your supply chain, especially in emerging markets. And think you're going to get away with it. So profit and principle inherently go together, and I think they're complementary. And to maximize profits, you need to be principle driven, and you need to ensure that you're robust and securing or ring fencing against any shock to your systems.
Yeah. I mean, that's also what I see more and more in whenever we advise, is that there is this, oh gosh, we're realizing that this is actually going to have a profound impact on our bottom line. Perhaps not right now, but down the lane. And also there's so many court cases also coming out now where you can really see the real risk. That brings me to, I also want to actually tell our participants that you're obviously more than welcome to just chip in and raise your hand or just basically interrupt us and come in with your experiences. But something that I know we've been talking about before, Daouii, and it's actually really funny because next week there is this major sort of event going on in Geneva, which is called Building Bridges. And it's an event over a few days where public sector and private sector try to come together. Useful or not, I mean, I think you make some contacts, and at least the two sectors now talk together. And I'm going to moderate a workshop on measuring the S. And one of the things that I'm going to say at the beginning will be, well, do we need to obsess about the measuring, the quantitative measuring? And I know we've been speaking a bit about this, quite a lot about this already, and that is this need to be able to fit something into an Excel sheet, and that it doesn't necessarily, and how can we move beyond that? And I also want to hear your thoughts about what you do to really have an assessment that's not necessarily, as you say, there's no one size fits all. And then also it doesn't necessarily fit into an Excel sheet that can just say, this is the score.
Yeah. On the environmental, I think there has been a huge focus in the past couple of years, rightfully so because of our climate crisis, on the environmental factors and how to help our world not only get to net zero, but become more robust against climate shocks, which is fair. But in doing so, we've created, I guess, our worst advocates saying, well, the S and the G don't fit into the similar ways that we can measure carbon. We can't measure human rights. I actually argue we can, and it's about holistically producing a scorecard. And yes, there are qualitative factors, so you can't necessarily measure health and safety, but you can measure health and safety incidences. And you can see what policies and procedures have been undertaken to mitigate certain issues or what remediation has happened. So I would argue that, yes, you can quantify anything under the world or under an umbrella. It's the matter of how you choose to quantify it and what value you're putting on it. For some, the governance issues outweigh social issues, or social issues outweigh environmental issues, depending on what sector you're looking for. So it's about materiality. At Channel, we've produced a scorecard. So everything kind of feeds into the scorecard, and corporates and clients are ranked from a score to 0 to 5, 0 being the lowest risk and 5 being the severe risk. And if somebody's ranked a 5 at the end of our ESG analysis, we won't touch them. It's just way too much inherent risk for us. So there are ways to quantify it. You just get sophisticated about it and create methodologies to enable you to quantify. But I'd argue when you quantify, especially on the social and the governance factors, I think you do yourself a disservice by not being able to see the underlying causes. And I think this is one of my biggest grievances with data providers right now, is they give you this packaged up one score ESG, and you see a client, it's, let's say, a 90 out of 100. That doesn't tell me absolutely anything on what's happening. And some corporates, there are issues where they are detrimental and they are severe. So when they're disguised and packaged in this very complex methodology of a rating system, I don't know what's happening. So internally for us, we actually used rating providers as a litmus test for our own analysis, just to make sure that we're on par. But then we can also back on what we found intellectually, rather than just saying, well, client X has gotten a score of 30 on Sustainalytics. 30 is closest to 0, which is a good score. That's why they're great. That doesn't help us holistically understand. I tell our portfolio managers, these things are important because it does eat into the bottom line of the company. And then naturally, being in the debt space, it does eat into what our potential, like it increases the risk of default and non-payment. So we need to make sure that these things are safeguarded and ring-fenced, but at the same time managed appropriately, both from us and from our clients.
No, I think I have that same thing that, you know, yes, some things, as you say, in health and safety, as well as in, for instance, the impact you have on your community. Let's say you operate in emerging markets, you can see what you've been doing over the years that have let's say, helped civil society to prosper, that has engaged civil society. You can see that you can actually measure over the years. You can see if, let's say, 3 years ago, you had children working for you, you did your due diligence, and instead of doing the stupid thing, which is pulling out, you actually stayed in and said, okay, so what do we do in this situation for the children? Did you create a vocational training program? Did you engage the civil society or the local communities in schooling and things like that? And those you can measure over time, right? But I think it's also that things like that takes more time to measure, perhaps, and that can also scare people off. And exactly as you say, on the governance side, it's very often yes and no. Do you have a policy on this? Is it actually efficient? But then when you start thinking about, is it efficient? Well, then obviously you can see, is it being used? How many times is it being used? But I'm like you, I'm saying it's fine to get people to understand that it's not completely quantitatively unmeasurable, but you need to understand what's actually going on behind it. Also, because if you want to actually make progress, you need to understand what is going on, where is it that people are trying to do better, because a moment in time where you get your scoring does not tell anybody where you're going.
Yeah.
And I think that's lacking a lot too.
And like you say, the whole benchmarking component, when people say, well, it's hard to measure, in 5 years' time, when ESG is very mainstream, more so than now, we are going to be benchmarking clients. We're going to be looking at industry benchmarks. So for clients, it's better to get ahead of the curve and have more years under your belt. To give you an example, internally, we were looking at one client and they've started this whole sustainability program and they've been reporting on it. However, it's only been for 2 years. And one of those years is the pandemic. So all their numbers look absolutely amazing and they have this sharp upwards progression. Then when you look deeper, you're like, well, it's been COVID, things have been shut down. I'm pretty sure this upward trajectory isn't because of their amazing risk management or sustainability program. It's just the sheer nature of luck on their side with the pandemic shutting down business operations. But for us, we didn't invest in that company because we didn't have a long-term enough track record of sustainability progress. And for us internally, it's a 5-year benchmark. We think that's a key medium, like short, medium term benchmark, but moving forward, it might increase in a couple of years to 10 years or 7 years. And for corporates, you're better to get ahead than you are to sit back and say, well, it's not going to matter and I'll do this in a couple of years. There isn't, I don't think that time is on that side.
No. And what I also see from the regulatory perspective is also that it's going from sort of, do you yourself evaluate that you think you're doing something on this, to tell us how. So you think you're doing good on social, for instance. Okay, so what's your due diligence, human rights due diligence in your value chain? What does it look like? So it's becoming more and more, which is also good because it gives guidance, right? It gives like, okay, so I need to think about this. So it's not, I think it's sometimes also on when these things come out from regulatory bodies, people tend to think, oh gosh, now we're going to be constrained, instead of thinking, okay, this actually tells me what is it that I'm supposed to be showing, instead of just leaving me in the dark with, you are going to in 2030 show this, but there's no stepping stones until then. And this could actually also help in guiding people, I think, in what they're doing.
Exactly. And the regulations, like you say, people are almost, especially in finance, a bit, I think it's twofold. You have two camps. A couple of people are excited for it because it finally streamlines and standardizes what is ESG, what's sustainability, how are we defining impact. I think a lot of these sustainability buzzwords are now bundled into one ESG, and which isn't impact investing isn't ESG. Green financing isn't ESG. So it'll allow for some standardization. But I think also more importantly, it is a blueprint and a framework. And when we look at social and governance factors, a lot of these are regulations that corporates do have to follow. And if they don't, they are at risk of either being penalized through fines from the regulators or from the courts. So it's not something that's brand new or coming out of the woodworks. The human rights standards or labor standards, especially in developed markets, are something that they've long been told to uphold, and they are scrutinized by, if it's not regulators, then by human rights tribunals and the likes. So it's not anything new, and there are blueprints out there on best practices for better social integration, labor integration, governance. I just think people get lazy and they just want an easy way out.
I think people get lazy, and I think that there's a shock to the system that you can no longer just do things offshore and get away with it. Now it is, because I don't think that a lot of people have been doing this to be mean to other nations or to people living far away from them. I think it is a question of, this was cheaper. We don't really ask too many questions. And now all of a sudden you see companies being sued in the jurisdiction where they're domiciled for things that I have done overseas. And you see consumers being much more attentive to how things are produced, not only in, let's say, the UK, but where was the cotton actually picked by who? The cocoa industry is like, how do you actually get, chocolate that hasn't been picked by children in exploitative situations? So there's a lot more attention towards it. But as you say, this is nothing, the regulations are there, and most of the investors, not most, but many investors sit in a global north where this has been enforced for many, many years. It's just that now the attention is also to, well, with globalization, what are you doing in other countries where perhaps the rule of law is less respected, and you actually have a major role to play as a company.
Our supply chain and global economies are global by nature, and our global economy per se. I think we saw the extent of that in COVID when supply chains were halted and there was no movement of people or goods, shortages across. I live in the UK. We saw food shortages. I almost felt like I was in a zombie movie of sorts, trying to go into your local Waitrose to shop, and there was absolutely nothing for weeks on end, or you were limited to 2 cartons of egg or a carton on certain days. So by nature, our supply chains are global, and we're so interconnected. And I don't mean that digitally also. I think it's easy to forget other people's suffering and problems when you're living in your own little bubble. And we're all guilty of it at one point or the other. But to say our supply chain, I guess my main point here is our supply chains are interconnected and they matter. And historically, governance didn't matter. Sustainability didn't matter. It was, what's the profits? What are their revenues? What's the cash flow? And no one really asked how, or no one asked why. And now people are starting to ask those questions, and hopefully we'll start seeing some better behavior from our large corporates. Because if we look at a lot of the destruction that happens in emerging and developing markets, it's not from local corporates. It's large, oftentimes extractive, in sense of the global south, extractive companies going down there. And whether it's corruption and bribery and paying off government officials, in some instances, overthrowing democratic elections. We saw that in Zimbabwe with a large mining company. I'll go by saying no names here, but undermining democratic elections and institutions, to forced labor, indenture, all those practices just to basically increase profit. And no one batted an eyelid, and no one cared. I don't think no one cared. I think it didn't matter then. I would say that more of it wasn't in their face, and they didn't have a way to be able to capture that information.
Yeah.
And now we can capture that information and we could see it. And it's really important that we do start looking across the supply chain and start rewarding good behavior, because there are good behavior. But we also need to know that building a school as a CSR effort shouldn't be seen or rewarded as ESG. That's called CSR. It's what's material to that company's operations and how are they doing good, but also mitigating risk and ring fencing that.
And also you can't, I think it's important to say, do no harm is not necessarily enough, but you can't, exactly as you say, you can't do whatever it is that you please just for the profit and then build a school and think everything's good.
Yeah.
I mean, that's not, so I saw something really interesting also, because you said extractions, and that was also the thought that, green energy or renewable energy is now a run on the cobalt mines, obviously in Congo, in DRC, and the conditions there are not necessarily, the best. So very often it's also, everything that's green is good, but then you don't necessarily look further down. So how did you actually get your minerals? What happened to that? And also in the general public, the interlinkage between, I mean, how are we talking now, right? And we all have, well, okay, this is getting old, but it's not that old. And this comes from mining, and we wouldn't be able to do this without precious minerals and certain minerals that are definitely mined, not necessarily in the best conditions. And then you have investors say, oh no, I'm not touching mining, for instance, because it's dirty, it's dangerous, and what have you, but we can't live without it. So it's better to actually have an engagement with those companies than it is to simply say, well, I'm squeaky clean, but yes, okay, but where did you get your computer from? Where did you get your cell phone from? And make those connections also to not only the people who are actually living and working there, but also the entire areas that are then becoming uninhabitable, and then you have migration movements, and you have a lot of people saying, oh, why don't they just go back to where they come from? Well, because of our consumerism, where they come from might not even know anymore. It might not be livable, but it also might no longer be theirs, because you have a multinational who's actually bought the entire area of a country, and hey, that's now theirs, and it used to be the homes of people, right?
And I think you raise a really good question there, is how far down the supply chain do we have to go when we're looking at, in, I guess for this conversation, ESG integration, and when we're examining companies. And it's a difficult one, and it's something that I question a lot, because no one's ever going to give you their secret sauce to who their vendors are, who their suppliers are, where they're sourcing from. But what I really appreciate about the debt space is that oftentimes, especially for us, we also have a trade finance function. You can see who the source is and who it's going to. And oftentimes clients will disclose, especially we have a lot of extractives in our books, where the source of the mines are. And then we can do the due diligence there. And to your point on transitioning to a green economy, there is an element where a lot of these commodities and sectors that are oftentimes controversial right now, truth be told, they're required to transition towards a green economy. So we can't just blanket put stuff on exclusion lists and just turn a blind cheek, because for every 2 pots of green finance or ESG finance, there's a pot of brown finance, of somebody willing to finance them. It's about how do we engage with our underlying corporates, with our, I guess, partners, and even investors to drive a sustainability agenda and help them transition over time. It's not a flick of a switch, and we're not going to wake up tomorrow and drive solar powered cars and live in, a net zero or a completely carbon neutral environment. It's how do we systemically get there, and how do we change the brick and mortars, mom and pop shops as well, because oftentimes right now you get impact sustainability statements from very large corporates. And yes, they have all the money to throw on sophisticated branding and teams to be able to come up with intricate policies. But when you look at national economies, they're often in the UK, it's driven by SMEs and the service-based economy. So how do we help those clients as well transition, and how do we engage adequately there?
Yeah. I just want to ask if there are no comments and questions from somebody else. That's sort of like a prompting you to and nudging you to say something. Nobody? No. Well, is it because we're boring? Oh, they've all gone to sleep.
I'm here. I'm not asleep.
Oh, hi, Martina. So do you have something to say?
I'm just fascinated by the discussion. And, as you know, the impact management platform, we now all have to say, they launched this afternoon. I don't know if anybody had a glimpse. I don't know. I think it just makes it even more complex, to be honest. So maybe a question would be, if you would meet a small asset manager or a family office who haven't done anything in this area at all, how would you go about convincing them, first of all, that this is deeply necessary, that it would actually probably align with their values, and just from a practical point of view, how would you get them started in ESG integration?
That's a very good question. And a part of me wants to be rather cheeky and say, you start by Googling especially I'll caveat this by in the private debt or in the debt capital market space, it's a bit different. And that's where the angle I'm speaking from. So not in the equity space, but if you Google your underlying investments, the name of the company you're looking to invest in, a lot will come up. And I tell my portfolio managers all this, before you come to our ESG team for an analysis, Google the company that you're looking to invest in, or Google the asset or the source of money or whatever information you have. And if anything doesn't come up, then come to us and we'll do a deeper due diligence. But first step should be get a holistic understanding of the investment. Just because the asset looks great or the corporate looks amazing from a paper perspective doesn't necessarily mean it's all roses and daisies. To give you an example, and this is probably one of my favorite examples to use to time. So a couple of months ago, one of our PMs emailed me and said, I'm looking at this investment. They just launched a sustainability bond. It's all clear. It's going to be amazing. I know there's no ESG issues, but just running this by you. And lo and behold, we had about 6 pages of our ESG notes. Usually our average ESG reports are 2 pages, a page and a half. We had 6 pages on this client, and every ESG factor in their industry, they had about 2 to 3 incidences of, from bribery and corruption all the way across to like labor issues, health and safety, and they were a large agri-food company. And I called our CIO and I said, look, this could have been mitigated by one Google search, their name, and then find bribery, corruption, whatever keyword you want to use to figure out whatever sustainability factor you're looking at. And I can guarantee you that the Wall Street Journal or somebody else will have an expose written on them. So our team spent 4 hours writing about 5 to 6 pages. Your PM could have mitigated this by one Google search. On the question or on the topic of how do you incentivize smaller asset managers or family offices, I think there's a pragmatic way of labeling ESG, and it's not about, yes, it's about principle and aligning to principle, but more importantly, it's more of a robust asset management, asset selection criteria, and allowing them to be able to choose the best in class companies to invest in. Caveating again, this is in the debt space, but it's about holistically understanding your investments, and it's a risk management practice rather than a do good or feel good aspect of investing. And there is, I think, a natural output of it is doing good by nature because you are investing better, but it's a more strategic, systemic way of investing, and it's more risk-based. So that's how I talk when we're speaking with our partners is this isn't necessarily, we're not telling you to do philanthropy, and we're not telling you that your returns are going to be undermined or compromised in any way, but actually this is helping you get better returns because the clients you're investing in are going to be more robust against external shocks, and they're going to be more than not ahead of their peers in their industries when it comes to innovation and staying ahead of market trends.
I think also just to say that, you know, Daouii and I come from different angles. I have to say, I think we come from the same perspective, but from different professional angles. And I think what I see a lot also is that you have a lot of companies, be they small or big, who really actually realize that they need to do this or who want to do this. And I don't really care what their motivation is. I mean, if it's because they want to look good or because they feel that this is actually the right thing to do, as long as they do it. But I think that a lot of them are also hesitant because they don't really know where to start, right? And I was just advising somebody they do wealth advising, actually, they are wealth advisors, and they advise an investor that is investing in the agricultural sector in a Southern European country. And there's a lot of irregular migration, and there is a lot of exploitation of those irregular migrants. So we really came in and said, so what is it that you can do step by step to not only say, okay, so this is a sector that we want to invest in, but hey, there are too many red flags around this, and we're afraid to get caught by the police or by social services or immigration services, or blah, 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 blah. But rather say, okay, so we actually do our due diligence, we find out where the potential problems is, and then who do we engage with to solve it? What are the issues around regularization? What are the issues around respecting labor rights for everybody? And how long, what's the time frame? Because then you also create an entire story around what it is that you're actually doing to make your investment better. And I think for them, it was really interesting to get that, okay, so what is it that we actually should do do it better instead of just saying this is dangerous for us. So, and then they can take this on board or not, because I'm not a financial investor. I have no idea about the value of the investment or the assets. Is it getting better or not? But, you know, bring that perspective in too. And I think for them, it was really valuable to have somebody tell them, so if you run into this issue, which you probably will, but you really want to invest in this area, in this specific region, then what are the steps you can do to mitigate bad press, mitigate issues with local governments, mitigate issues with local populations? And I think that, you know, it's also about, as Daouii said, making it practical, making it pragmatical. And then also, I think also saying that, look, this is complex, but I think there's a difference between complex and complicated, because the world is complex. And there's just, I mean, my little life in my little bubble is complex because I interact with other people. Sometimes we don't understand each other. And, you know, it's just, that's life. It's the world. But there's a difference between making things complicated and accepting their complexities.
If I may jump in with just one last point, Kristina, as we were speaking, it came to mind. With smaller asset managers, they do have a fiduciary duty, and asset owners now, more, I would say North American, European asset owners are expecting sustainability, are asking. So when they have a DDQ, they are asking what your ESG strategies are. Are you a signatory of the UNPRI? Do you have an in-house ESG policy? So I would say it's still very nascent, but as time progresses, it will be the baseline to be able to get funding and investors on board to your funds, and getting capital backing from asset owners who also have fiduciary duty. And this is becoming something that's not just a marketing ploy or something that we see people speaking about, but just the baseline of how we should be investing.
Martina, do you want to? Yes.
Yeah, no, thanks so much. But just in the realm of, you know, keeping things simple, here's another question, then I will stop my questions. So how do you move from ESG integration to net positive impact, if we're all in agreement that actually that is what we should aim at? Because even if you would have a sensible and up-to-date ESG integration approach, the bottom line could actually still cause some harm, right?
Yeah, and that's a very good question, which I don't have a definitive answer for. I think it's something that we're all trying to analyze, but it's also dependent on, I think the first thing that comes to mind is dependent on your asset class as well, and what it is you're investing in, and also how you're defining net positive impact from a climate perspective, or is it more broadly from a sustainability practice. And hopefully with regulation and industry bodies defining impact and impact measurement and giving us more guidance, we can get to that point. But right now, the dial is moving towards getting everyone on board on baseline ESG integration. And once we figure that one out, I think we can holistically move towards a more impact-driven form of investing where it becomes simpler. In the private markets, it's increasingly difficult for us to not only make claim to impact, but also understand and be able to measure and report on our impact. So far, we're getting to grips with ESG integration and sustainability integration as a whole, whether on a fund level or on a more broadly firm integration. So I don't have a clear answer to that. It's something I'm happy to discuss and put some pen and paper with you over coffee, but I don't think anyone within our space right now has systemically figured that one out.
My hope, and here I'm coming, I mean, I wouldn't be able to understand or even start, I mean, the difference between the asset classes and things like that. But my hope would be that we start using the SDGs as what they're actually intended to be. And that is it's a set of tools. Because what I think that is happening now is that everybody's reporting on the SDGs, right? You don't see an ESG or a sustainability report that doesn't have all these lovely little squares put up as an abstract piece of art. I mean, it's better than Picasso. Doesn't mean anything, usually doesn't. I mean, most often it really doesn't. But what they do, if you look at the little pin that everybody has in their label, right? It is actually about considering all of these goals in a holistic way. And I hope that that can also help doing is looking at the looking at, okay, so if I impact this, if I focus mainly on, for instance, agriculture or food, what are the things that I have a direct impact on? If you say agriculture, one thing that clearly comes to mind, for instance, is it's water, it's pollution, right, from cows, from manure and things like that. So what did I do to make certain that I don't pollute the local water streams, and what sort of impact did that have on society? Well, probably positive. But what if I extended my farming into land that might have belonged to somebody else? Did I actually, did I harm them by putting up for instance, my water plant, my water cleaning plant? I am now babbling, but you know what I mean. And also, when you think about, for instance, doing things for the environment, I mean, say clean energy, I think it's important to say that the do no harm doesn't mean don't do it. It means have mitigating factors. Think about the factors or the things you can do to mitigate negative impact. You want to establish hydro energy. Well, it's very often that you then actually end up flooding people's where people live. What is it that you can do? Is it worth it? If yes, then what you do to create resilience and to have a planned relocation that is actually planned with the people that you need to relocate, so that it's respectful of them, even if it is for them probably not the world's most joyful solution, right? But it doesn't mean you can't do it. And I think that it's about going away from like doing no harm means, oh my God, I can't do this if I figure out that this is causing harm. It's about, okay, I'm figuring out that there's a risk of causing harm here. What is it that I do to avoid that harm is irreversible or is not mitigated? Does that make sense?
Yeah, absolutely.
Okay, because I felt that I was no longer making sense whatsoever. Anybody else has anything that they would like to contribute with? Daouii, any last thoughts?
I think because you said the SDGs, my brain is on the SDGs, and they were formulated to be the world's largest business opportunity, combined business opportunity, or something around those lines. And it's estimated within 4 sectors that it's $12 trillion worth of opportunity. But when we talk about the SDGs, people think automatically charity and philanthropy rather than business opportunities. And when we talk about, or when we use language that is oftentimes not natural to people within investment banking or finance in general, they get very spooked. And then they automatically say, well, that's CSR, or that's another function of this business. It has nothing to do with what I'm doing, so let's bother someone else. I guess my question, or something that I always struggle with, is how do we properly integrate the SDGs into the work that we're doing? And more importantly, how do we ensure that there's a fair and systemic, equitable approach on SDG integration that isn't a bottom or a top-down trickle? And when I say top-down trickle, I mean across the supply chain, and ensuring that there is robustness. There's a cost. I know there's a cost associated with even sustainability and transforming corporates and industries to become more green or holistic. But the SDGs is one that I struggle with. And I know there are tangible key performance metrics and indicators, but to earnestly look at them and say that you can equate your investment to them, I think is a bit of a stretch. And it goes back to Martina's question of how do we systemically get better impact? And it's a question that I grapple with, because I see the SDGs everywhere. Somebody has a sustainability report and they go select a handful of SDG stickers and they plop them on there, which infuriates me sometimes. So like, how does this in relation to the SDGs at all? It's a small, I guess it's a small move of a dial, but how do we create profound impact and help us meet our SDG targets? It's not going to happen in 2030, but you know, if it's 2050 or 2060, how do we get there with the capital that's being allocated and funneled towards green, better businesses?
Yeah. I mean, I think so I've been working on the SDGs like forever, right? And I think it's true that one of the big obstacles we have is exactly what you said at the beginning. People get spooked. You know, the moment you bring in something that, especially at a level where people have been used to operating within their field for a very long time, and therefore it's been a very, very long time since they last said, I don't know, which from a completely sort of human perspective is normal. And all of a sudden, all of this sustainability blah blah is being pushed onto people who've been working in a sector that this isn't the sector where this was hosted, so to speak, and they're being asked to do it, like from one day to another. And I understand why that spooks. So I think that part of the solution has to be figuring out actually, how do we speak about this to people who are very unused to say, okay, I actually don't know how to do this, in a way that lets them accept that there are things in this that other people have to bring in. And I think now you've somehow managed to do that in Channel, because you sit there with this portfolio and you're clearly able to speak a language which isn't that let's say traditional finance, like very like this is only about the bottom line language.
But it hasn't been easy, and I think it's a challenge from my perspective, for me and for portfolio managers as well, right? Because there was a funny joke that we now use internally that we're not being Jesuits about our ESG integration, and we're trying to be more, I guess our key phrase we use all the time is holistic in our approach, because we do recognize that there is crossroads, or when the rubber hits the road from principle to like profit, what do we do? And I think the key there is the engagement approach. So it's about maintaining an open mind from my team's perspective on some of the investments. I was speaking to a counterpart in the markets, and their ESG team basically don't touch commodities at all. So they refuse to do it, which I think is a bit extreme. And we had a discussion around it. And their ESG team sits outside of their investment team, and they don't really communicate as much beyond just doing the ESG due diligence on their transactions. But I'm like, how do you not touch commodities, and how do you do trade finance? Inherently, there will be, whether in the first degree or the second degree of layer, you'll have some sort of commodity exposure. And that was his frustration as well. So for me, and my team, it's about realizing and learning how to speak the language of the portfolio managers. But on the same token, it's the portfolio managers learning and realizing what factors we're looking at and why we would have an issue with the deal. And it's not about, I guess, emotions or being having a firm belief in trying to make the world a better place, but it's about believing that our security selection criteria needs to be more robust. And when we are bringing an issue, it's something that's going to have detrimental impact to the underlying structure or the repayment, or it's a risk similar to a loan default would be. So it's a delicate art of tango that we both had to learn from both sides, and it's not easy and it's not perfect. We're constantly refining. We're trying to find better ways of working within ESG in itself, but also working with our PMs to help them start seeing opportunities. Because right now we're doing it strictly, for the most part, through a risk-based approach, but there's an upside opportunity that we want to start capturing. And how do we do that without limiting their own existing books?
Well, I think we have the final sort of sentence of this little webinar, this little chat, is that doing better is a fine art of tango.
Yeah.
Yeah.
Certainly. It's never going to be perfect, and you know, you have to give yourself room to learn and grow, and we're all going to make mistakes, right? You'll invest in a company that looks clean, and tomorrow they'll have a sustainability issue, right? But it's about how do we manage it, and how do we create better dialogue and better engagement from both ends of the spectrum, from an investor's perspective and from a corporate's perspective, to do better. And
and not make it about being perfect, but about actually learning and doing better.
Exactly.
Martina?
Yeah, I just like to say common sense is one of my favorite tools.
But it's very uncommon.
Yeah, well, you know, like you said, a Google search, right? And my favorite example is also Johnson & Johnson. They had a fabulous ESG rating before the opium crisis hit, right? So sometimes you just have to use your own judgment. And, you know, if our ultimate aim is indeed net positive impact, then I think we need to align ourselves in terms, you know, our own lifestyles and own choices. And then it's much better to have that common sense view and not to be afraid of asking the right questions, the tricky questions. But thank you so much. It has been so informative and so interesting. Thank you both so much for your time.
Thank you so much. Thank you, all of you, for being here. I hope you enjoyed it. I know that I had great fun, as I always have with Daouii, so thank you so much. And I hope to see you all soon for another Women in Sustainable Finance event, and elsewhere for coffees and chats whenever you want to. Thank you, and have a lovely rest of the evening.
Thank you all for spending your evening with me.
Thank you.
Thank you. Bye-bye.
Bye.